I'm about to show you the most important number in private equity. When people are looking at businesses to buy, it's very important that you can determine what is the profitability of a company. And so I'm going to show you today the numbers that you need to know if you want to make millions from this opportunity. Everyone gets confused about the two main numbers, which they think is the numbers that you need to know when it comes down to buying a business. First off, there's profit, and then second is going to be cash flow. Profit is going to be your revenue minus your expenses, and your cash flow is going to be your profit or your cash collected over a period of time. When you're looking at businesses online, you're going to see a lot of people talk about profit and cash flow, and they're going to be confused, and they're going to get you confused because a lot of people don't understand that neither of these numbers really matter because they don't tell the whole story. So when you want to find the profitability of a business, you want to find the number that actually makes sense. You want to find the number where profit and cash flow actually tell you what the business actually makes. And the thing is, profit for me could be different from you, and cash flow for me could be different from you. And so what ends up happening is that people are throwing out all these numbers for how profitable or how healthy the business is, but there's no way to normalize them. But that is until we get to our final metric, which is EBITDA. And so essentially, don't worry about the profit, don't worry about the cash flow. Both of these don't really give you a true essence of the profitability of a company, but the number that you do want to know is going to be your EBITDA. So that's going to be EBITDA. Essentially, when you're seeing these numbers, profit and cash flow, if you go to Biz Buy Sell and you're looking to go buy a business, you'll see that they have cash flow listed. And cash flow, because it is just some amount of cash collected over some certain period of time, it doesn't give you enough information about what does this business really make. And again, when you're using profit, all you know is the revenue minus expenses. But if I'm running the company and you're running the company, my expenses are different than yours. So both of these are going to be invalid for actually determining the value of a company. And so that's when we come down to EBITDA. EBITDA stands for earnings. See if I want to write this out for you guys. Earnings before interest, taxes, depreciation, amortization. Earnings for the business are going to be when you're looking at the tax return, there's a certain area of the tax return that you want to go for. It's going to be where it shows net income or it says taxable income. That's essentially the earnings of a business. So at the end of the year, when you send in your taxes and you have that earnings call, and you also know how much money is this company making at the end of the year, you're going to see right on the tax returns, taxable income. Those are your earnings, right? How much money was earned throughout the year. In order for you to understand this calculation, you want to understand your earnings before, right? The earnings before you had these essential write-offs, right? And so the write-offs that are going to be normalized for everybody are going to be interest, taxes, depreciation, amortization. These are write-offs that apply to every single person differently. So my interest is going to be different than your interest. My taxes are going to be different than your taxes. My depreciation, amortization are going to be different depending on who's the business owner, how you bought the company. Was it a stock purchase? Was it a asset purchase? And so when you're looking at the tax returns, you're going to find what the earnings are, what that taxable income is, and then you're going to add back whatever the interest is, that whole line item, right, from the tax returns of interest, the whole line item for taxes, and then the same for depreciation, amortization. So now that you know these criteria, you understand what the earnings are, and once you add back interest, taxes, depreciation, and amortization, this is what's going to allow you to normalize, right, the profitability of the business. And so now you took your earnings, you added back, let's say the earnings were $100,000, you added back $20,000 of interest, you added back $15K of taxes, the depreciation was, let's say, 100 grand, and then the amortization is going to be 10K. And so if you were to look at the profitability of this business based off just profit or just cash flow, you'd say this business makes $100,000 a year. But when you're valuing a business, you need to use the term EBITDA, which is going to be the earnings before they took out the interest, taxes, depreciation, amortization. So once you add those all back together, you've got 10K, 100K, 15K, 20K, 100K. Now you determine that the actual profitability of the business, not just what the income statement is saying, and not just what the tax returns are saying, but what the true profitability is that applies to everybody, because now that's normalized, is 245K. And so that is what you're gonna now multiply by, depending on the industry, depending on the risk, you're gonna find a multiple, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and multiply it by this number. So essentially, companies that you're looking to buy, they're gonna be using EBITDA, but actually, these companies should be using SDE to determine valuation. Same strategy, you're going to determine a specific type of number and then use a multiple to define the value of a company. But there's a major difference between these two. So this is going to be the seller's discretionary earnings. And so seller's discretionary earnings are different than EBITDA because discretionary earnings are earnings that the owner can use at their will instead of the true profitability of a company. And so why this is important is because your seller's discretionary earnings are essentially money and profit that comes into the bank account of the business owner that the business owner then can spend at their discretion. And so what ends up happening is that the true profitability is hidden in SDE and EBITDA because seller's discretionary earnings, they don't include the business owner's salary. And so the business owner is usually the one who's running the company. And so when you're buying a small business and you're looking to buy a company, you might be using EBITDA, but you forgot if the seller is the one who's using discretionary earnings and they're running the company, they might not be paying themselves a fair salary. And so if the business had profitability of, like, remember we got that calculation earlier, 245K, that's what I was looking for. You know, after debt and things like that, I'm gonna have like 100 grand left over. This is a great opportunity. I'm gonna have a 6-figure salary. Boom, boom, bam. You're thinking you're gonna get rich. You forgot to come in here and look at the real numbers and say, okay, does this make sense at 245K, or is it actually seller's discretionary earnings? So is it really the 245K of EBITDA, or is it actually seller's discretionary earnings? And so what I mean by that is if the owner of the business, again, is not paying himself a salary, and to replace him in the business, it costs 100 grand. So what you need to do is you need to take EBITDA and you need to subtract the EBITDA calculation, which is 245 minus 100K. And so the true profitability of the company, because again, remember, you do not want to buy a business that is inherently actually a job, right? So when you're buying a business, you think it's 245K of profit, right? You're looking at the EBITDA number, $245,000 of EBITDA. But in reality, because you have to replace the owner, you don't want to be the one who buys the business and then you go in and operate, right? You want to buy the business and then replace the operator with someone else. And so if they were running the company and it costs 100 grand to replace them, they said they had 245K of EBITDA, but really the business is doing 145K. And the reason why, again, is because you have to understand, they told you that it was EBITDA, but in reality, it's actually seller's discretionary earnings because they forgot to add back the total amount that the seller costs to replace. And so if they cost 100 grand to replace them in this specific field, 100 grand, 120 grand, 140 grand, you need to go back and figure out what is my EBITDA number, subtract the owner's salary, and then you get true EBITDA. Then you get the true profitability of the company. And now you can say, okay, now I understand what to value this at. So if you were gonna pay, and by the way, this matters a lot because if you were gonna buy a business for $245,000 and pay a 3 times multiple, you're paying almost 750 grand, 735K to get that business done. 735K because 245 times 3. You buy the business thinking, okay, great, I found the EBITDA, I know the profitability, and then you realize that you have to replace the owner because they're gone. You don't want to buy yourself a job, you want to buy yourself a business. And so that means you need to replace the owner with someone who's not yourself. In order for you to be able to do that, that 100 grand is going to have to come out of the profitability of the company. And so what ends up happening is that you have 145K, you just paid 735. So a business that you thought you were paying a 3x multiple for, it actually really, in reality, equals a little over 5x. That is a multiple that I would never pay for a business this small. If there's a business that's doing less than $500,000 in profit, you already know this business is gonna have its headaches. And like I always recommend to people who I work with, don't buy small businesses. You wanna buy businesses doing $300,000, $400,000, $500,000 EBITDA at the minimum. And so if you're looking at 245, that's already kind of small. If you're looking at 145, it's way too small. And so if you're gonna pay a 5x multiple, you're gonna be drowning in debt. Your debt service coverage ratio, which we'll talk about in a later video, is gonna be way off the charts. You're gonna have to overpay for this business. And what's gonna end up happening is you're gonna be paying way more in debt than in profitability. And you're now taking out even more risk. The business is small, so there's heavy risk on the business. But now that you're paying such a high multiple, you're overpaying for the business. And so now you're having even more risk, right? And so now you're paying back so much debt. Every time you get a dollar of profit, you're basically paying back 95 cents right back to debt. And so the real profitability of this business is gonna be that 145, where you really wanna be careful because people are always gonna talk about the EBITDA of the business in small businesses, especially business brokers, and they don't understand what they're actually offering you is SDE. And so what I like to do to get a discount, if I'm looking at a big deal, is I'll go out and I'll figure out, just hop on Google, okay, what is the cost to replace the owner? If they're 100, 150K, whatever they are for the year, that their annual salary to replace them, I'm immediately subtracting that from EBITDA. So I'll go find EBITDA, I'll go find the profitability, and then I'll immediately take it out of the opportunity and I'll say, okay, listen, you said it was worth 245, it's actually worth 145. I'm gonna use my multiple there. I'm gonna multiply that number, and I probably wouldn't even multiply it times 3 anymore because it's such a small business. I might give you 1 times, 2 times for a business like this. So it might only be worth 145, 290. If you were gonna pay that 735K, you're literally not getting a deal. You thought it was a deal, right? You thought you were paying 3x, right, for 245. But it's not a deal at all. So stay away from businesses like that. Another thing that I do want to mention is that when you're looking at a business, right? Because what is this true number? It's telling you the earnings before all of the add backs that allow you to standardize the profitability of a company. And so a lot of times, especially if you're buying an asset heavy business, so think about businesses with lots of equipment, cars, trucks, machinery, things like that. What ends up happening is that on the tax returns, those are great write-offs, right? So let's say that you have, let's do an example here. If you have earnings, which are 100 grand, before interest of 20K. Let's say the taxes are 20K. Let's say the depreciation is 100K and the amortization is 10K. The depreciation and amortization are very similar to the same things. They're both essentially write-offs. And so depreciation and amortization, just think of them as value loss over time that you're able to write off on your taxes. When you have 100K of depreciation and $10,000 of amortization, you have to determine what type of business is this? Because sometimes the depreciation and amortization are not add backs. They're not things that you should be adding back to the profitability of the company because they're true expenses, right? So if I'm looking at real estate, right, that's asset heavy, capex heavy, right? Capital expenditures are high. That's essentially what depreciation and amortization are. They're capital expenditures, capex. These are going to be true payments. And so what I'm trying to get at here is that when you have EBITDA, earnings before profit, and interest and taxes, right? This is the line where Warren Buffett stops. And so if you know Warren Buffett, he's one of the greatest investors of all time, probably the best. And so Warren Buffett, he tells you that when he calculates a business, he's actually looking at EBIT. He's not looking at EBITDA. And it also depends on the business model because again, asset heavy businesses, capex heavy expenditures, these are not fake expenses that you're just gonna add back. Oh, because it's just a write-off on the taxes. It doesn't mean it's a true expense. No. If you have depreciation and amortization on a capex heavy business, trucking, real estate, things like that, those are true expenses. And they might not hit you today, but they will hit you in the future. And when they do hit, all of that money that you gave to the owners, 250K EBITDA business, right? And you just gave them a 5x multiple on that, right? It turns out that the business is not that. It was actually a 140K business. And so what's important to understand here is that when you're looking at most businesses, you actually do want to use EBIT, especially brick and mortar businesses. If you're using some sort of online, if you're buying some sort of online businesses, maybe you can add back depreciation and amortization if it makes sense. And let me give you an example here. When I was first getting started in buying businesses, I was focused on buying houses, right? And so I knew a lot about the real estate market. And so what I knew from real estate is that when you're multiplying or finding the value of a house, you can go back and do work to figure out what the cash flow is. But where most investors fail to realize is that they actually forget to do one specific calculation, and that's the calculation for capital expenditures. Capital expenditures, that's going to be expense that is real but is not paid today. And so capital expenditures is really depreciation and amortization. It's just another name for it. And the reason why is because let's take an example of a house. You bought a house for 100K and now you're paying $1,000 in expenses and your rent, right? Your rent is equal to $2,000. So now you have a $2,000 rent. And so essentially you now have $1,000 per month of cash flow. Everything's great for you in year 1, year 2, year 3, year 4, year 5. You're just rolling on all this cash flow. You brought in 60K over the last 5 years. And in year 5, you need to replace the washer and dryer. You need to repaint the house and then you need to redo the carpets. And so all that's going to cost you $50K. So now you have $45,000. So now 5 years later, 5 years, you double that, and now you have $90K, and then you got to replace the roof. The roof costs $20,000 to replace the roof. And so the true profitability at the end of the year, so you got big expenses, you got the roof, you got plumbing. At the end, you walk away with $50K over 10 years. By the way, this is why I don't invest in real estate anymore. $50,000 over 10 years is an absolutely ridiculous return. You're buying a house for $20,000. You could have went out and bought a business making $100,000 a year. And then even after debt, you're walking away with $50K every single year versus $50K after a decade. And so again, this is why you don't get into real estate, guys. You want to buy businesses. And so after 5 years, you made the $90K. Another 5 years, you made the $90K, 10 years in total. You spend all this money on repairing the plumbing and the roof, and then you walk away with $50K. That's what your capex is. That's your capital expenditures when you're looking at a business. That's your capital expenditures when you're looking at any business, whether that's real estate or a legitimate company where you have trucks and you have equipment and you have things like that. And so if you didn't do that math, if you never did that calculation, you would have thought that this business was going to make you would have thought this business was going to make you 120 grand over a decade. You would have thought that this opportunity in real estate was going to make you 120 grand. But you realize that in truth, there's capital expenditures, which you don't have to pay now. And by the way, when you have a real estate or you have a real business and every single year you're writing off that depreciation, it's because the government knows, right? Just like any good investor knows that that expense is going to come one day. So they allow you to write it off, 5K this year, 5K that year, 5K every year for a decade. And so yeah, you wrote it off and you got to claim all those taxes, all those tax returns. But guess what? And when the year 10 comes, that expense comes true, right? And it's due time and you need to pay that. And so what are you going to do? You need to make sure that when you're buying a business, especially capex heavy businesses, you only use EBIT. Don't worry about the DA. And so if you guys want to know how to talk to brokers about this, because they're gonna cry about it. Oh my God, I have to use EBIT. Like, oh my God, you can't use that. It's all about EBITDA. That's the true number. Everyone uses it. Okay, that's fine. What I like to tell them, here's how you get around it. You say, okay, I'll give you EBITDA. EBITDA, you said you want 250. Okay, 250K EBITDA. There you go. You got it. But I'm a prudent investor. I do my due diligence. And guess what? In my financials, I talked to my CFO, Raven, and what he told me is that I need to add 5 to 10% for capex. So now you add back, right, or deduct from the 250, 5 to 10% for capex. By the way, if you want to know what number to choose, 5 or 10%, just go back and figure out whatever the depreciation and amortization is, what percentage of that total profitability number, and then go ahead and add it back from there, right? So if depreciation and amortization is 5% of the total profitability of the business, you're going to deduct 5 to 10% for capex. And so that's how you get around it, right? So when you're going to a business owner or a broker and they're saying, you got to use EBITDA, that's all we care about. Hey, listen, that's fine. But guess what? I know this is an asset heavy business. And so what I'm going to do is actually, I'm going to take 5 to 10% for capital expenditures, and I'm going to remove that because I know that after 5 or 10 years, I got to replace the trucks, I got to replace the equipment, and I got to replace big items that you've been writing off for years that I know over a certain amount of time, it's going to come to where I actually have to make this payment. And, that's not going to be good for anybody if, especially if you have a seller note on the business, if overvaluing this company, right? So let's make sure we do it the right way. So again, I want to use EBIT, but if I can't use EBIT, want me to use EBITDA, I will allow them to do that, but then I would just add 5 to 10% to capex to make sure I get that number back to where it should be, because those are true expenses. Don't ever let a broker tell you that depreciation and amortization are not true expenses. They might not be true today, but they will be true in the future. And if you don't watch out for that, you're going to overpay for a business. And you're going to be in some deep trouble when the trucks start breaking down and you don't have the money to replace them. So essentially, I just showed you why you don't want to look at cash flow, you don't want to look at profit, the difference between EBITDA, EBIT, and seller's discretionary earnings, and which ones to use in what specific situation. And now you can take this and go value a business, and you're going to be 10, 20% smarter than the average bear. Now you can take this information and make sure when you're buying a business,
20% smarter or 10, 20 times? Bro, I'd say you're like freaking 10, 20 times smarter than the average bear.
Should keep that in there. Well, according to my producer, he's saying that if you actually use this information, not only you'll be 10, 20% smarter, you'll be 10, 20x smarter. And the reason why is because most people who are buying businesses, they don't have this information. They don't know anything about EBIT, EBITDA, seller's discretionary earnings. They're just like, oh, well, the broker told me this, the broker told me that. The most important thing for you to be able to understand is that no one knows anything except for the person who knows everything. All right, so I'm gonna wrap it up here. If you guys got any comments, leave them below. I respond to every comment. DM me on Instagram, Raven Harris, if you guys wanna reach out, and we'll go from there.